Hello and welcome to Options in Plain English Advanced Edition. Today we're going to apply what we learned about the pricing of at-the-money straddles to derive a quick and simple formula to price a 20 delta strangle from the price of the at-the-money straddle. This will be a way for us as traders to understand the pricing mechanisms that underlie the options market. With faster and better access to technology and information at our fingertips, we should not forget the unwritten rules that affect the pricing of option contracts. Whether we will ever have to do those calculations in our heads or quickly with pen and paper doesn't change the fact that the more you know about option pricing, the better the options trader you will become. We're going to start by going over what we already know about the at-the-money straddle. We've derived this formula for the at-the-money straddle in a previous lesson, so I suggest you check it out if you haven't. The at-the-money straddle is going to be equal to 0.8 times the stock price multiplied by the implied volatility multiplied by the square root of time. Also, we derived the formula for the delta of the at-the-money call, which is not 0.50. It's a little bit different than 0.50, and the difference is going to be equal to 0.2 times the sigma, which is the implied volatility, multiplied by the square root of time. Once we know this information, we can ask ourselves, now we have a quick and simple formula, very straightforward formula to calculate the value of a straddle. We don't even need to go to the platform. If we know the stock price, we know the implied volatility, and we know the time, we can get a good feel. It's not going to be exact, but it's going to be very accurate for the price of the straddle. Now we ask ourselves, could we derive a similarly simple formula for a short strangle? So instead of having the short call and the short put right at the money, we want a formula that would give me the value or the price or the premium for a short strangle once I know the value of a straddle. And this could be useful because not only if you calculate the value of a straddle and you want to know the value of a strangle, but you can go to a platform and quickly get the value of a straddle, which is just the at-the-money put and the at-the-money call put together. Once I have that information, can I figure out the value of a strangle without actually having to price it? You can price it in your head quickly. Well, we're going to start by getting a quick formula for the price of a 20 delta strangle. Why 20 delta? Because we know that once you're at the money, if you move higher or lower by one straddle, by one at the money straddle, you're going to be going lower in deltas or higher in deltas by 30. So 50, approximately 50 minus and plus 30 is going to be 20 and 80. And for this 80, the other side of the coin, the put is going to be equal to 100 minus 80. So the put is going to be priced, or the delta of the put is going to be 20. So we're going to calculate from the at-the-money straddle, short call and short put here, we're going to calculate the value or the premium of the short strangle, where the short call is at the 20 delta and the short put is at the 20 delta as well. We know that the at-the-money straddle is approximately 0.8 times the stock price multiplied by the implied volatility by the square root of time. We know that one straddle higher and lower than the at-the-money, so here and here, delta goes lower and higher by 30 deltas approximately. This is what we mentioned. So in this example, for example, it's going from 52 to 22 and then to 82. Remember, these are approximations, but they're pretty accurate. We also know that the delta for put, the absolute value, we don't concern ourselves with the sign here, but just the absolute value is equal to 100 minus the delta of the call. So if we have a call that has a delta of 80, then we know that the put has a delta of 20. The price of the call is going to be 1/2 of the at-the-money straddle, and the price of the put is going to be 1/2 of the at-the-money straddle as well. So the at-the-money straddle is made up of a short call and the short put. So each one of them has or are contributing 1/2 of that value. Now, if we want to calculate the price of the 20 delta call, what should we do? We know that the call is 1/2 of the at the money straddle, and then that the delta goes lower by a value of delta, because this is going to be going lower. Now we're calculating the price. Remember, the price, when the price changes, when the underlying price changes and it moves based on the delta, you're going to be making money or losing money by the distance that it moved multiplied by the delta. So in this case, the price of the 20 delta call is going to be equal to the value that it had, so 1/2 of the at the money straddle, minus a delta times the at the money straddle, because it moved one at the money straddle to get to the delta 20. Okay, for the 20 delta put is going to be an approximation that's the same as the call. It is 1/2 of the at the money straddle. We start right here, and then we move lower by one straddle, by one at the money straddle. So 1/2 of the at the money straddle minus a delta multiplied by the at the money straddle, which is the distance that it moved to get to the delta 20 put. Now, which delta are we going to use? When we start here, the call had 50 delta, or around 50, and when we finished calculating the value for this one, it ended up at 20 or around 20. So which delta are we going to use? We know that the price started changing at the money with delta approximately 50, and we ended up with delta approximately 20 for both puts and calls. Delta does not decline linearly because of gamma. So the delta is changing all the way here, okay, from the beginning to where it ended up. So for this approximation, we will assume that it does change or decline linearly. And this is a good approximation because, in fact, for this particular range, it does change not linearly, but very close to linearly. So what we're going to use is we're just simply going to average the delta at the beginning and the delta at the end to get a delta that it changed by when it moved from the at the money to this particular point, which is one straddle higher and one straddle lower for the put, one at the money straddle higher and one at the money straddle lower for the put, to get to the delta 20 put and to the delta 20 call. So we will use the average of the delta at the beginning 50 and at the end 20. So a delta of 35 we're going to be using for the approximation. So the price of the 20 delta call is going to be 1/2 of the at the money straddle, which is the value of the call initially. And to calculate the value of the call at the end is going to be minus 0.35, which is the delta because the price moved, times the at the money straddle because it moved by at the money straddle. So it moved by this amount, and we're going to use the average of both deltas. So we're going to use around 0.35 multiplied by the straddle. Same with the put, only moving lower. So the 20 delta strangle is going to be equal to the 20 delta call and the value of the 20 delta put together. So the 20 delta strangle is going to be 0.5 at the money straddles minus 0.35 at the money straddles is going to be 0.15 at the money straddles. The 20 delta put, likewise, is going to be 0.15 at the money straddles. So we arrive at the formula. The 20 delta strangle is going to be approximately, remember, these are all approximations, 0.30, so 30% of the at the money straddle. So what does this formula tell us? Well, it tells us once you have the at the money straddle, if you want to go out to the 20 deltas, and create a strangle, you are going to be priced at the 30% of the original at the money straddle. So if you have here the at the money straddle being, for example, $10, then the 20 delta strangle is going to be $3. And this formula applies no matter what. It doesn't matter how many days to expiration. It doesn't matter what implied volatility you're talking about. It kind of assumes that there is no significant skew. But again, this is an approximation. This is going to be useful because once you have the at the money straddle, which is also equal to the expected move for that period, you can easily, in your head, calculate if I go out to the 20 deltas, that strangle, how much money would that give me if I want to sell it, or how much money it would cost me if I want to buy it. Based on that information, you could make a determination whether it makes sense to put that on or not. For example, in our case, when we try to put on some positions, we would not initiate a strangle if it's going to give us a certain premium that is less than a certain benchmark that we have. So if a strangle is not going to give me, for example, $2 to begin with, so the initial credit, if it's not $2, then I don't see a point putting it on because of commissions and other transaction fees and our actual trading strategy. Because of this, it's going to be very useful to know that the 20 delta strangle is equal to 30% of the at the money straddle. So we're going to do an example here. We have a stock that's trading at $100. The expiration is 3 months, and the implied volatility is 20%. We have the at the money straddle being 0.8 times the stock price times sigma square root of time. So sigma is implied volatility. The at the money straddle is going to be 0.8 stock price, which is 100, 0.20, which is the implied volatility, and the square root of 1/4, because 3 months is 3 divided by 12, which is 1/4. The square root of 1/4 is 1/2, so it's going to be easy to calculate. So we can do it in our heads here. 0.8 times 100 is 80, times 0.20 is 16, times 1/2 is going to be 8. The at the money straddle is $8. Quickly, we just know this information. We can figure out what the at the money straddle is. Now, from that value, we can calculate the 20 delta strangle. So if I sell the at the money straddle for this example, I'm going to get $8. Okay? And I'm going to have a probability of profit of around 56%, 55, 56%, depends on skew and some other factors. But if I want to do a 20 delta strangle, I'm going to take in, of course, less of a credit, but the probability of profit is going to be higher. So 20 delta strangle is going to be 0.30 times the at the money straddle. Right away, I know that it's going to be 0.30 times 8. The 20 delta strangle is going to be $2.40. And not only that, I know that where the 20 delta strangle legs are going to be. I know that the 20 delta call is going to be located at the 108 because the straddle, the at the money straddle is $8. So I know that the 20 delta call is going to be the at the money plus 1 at the money straddle, 100 plus 8, 108. Same with the put, 100 minus 8, which is going to be the 92. So this is how it works, and this is a formula. It's a quick formula that can be useful in certain situations or just to determine whether a trade makes sense in terms of the credit received or any other parameter that you might deem important for your trading plan. Now let's go to the platform and take a look at a few examples of where this formula can be applied. So now we're here on our trading platform, and what we're going to do is I selected a stock that has a price that's very close to where the strike price is. So I selected Adobe, which has a price of $385, so which is where the strike price is, so that we're not caught in between strike prices. and the ticker symbol is ADBE, Adobe. And trading at 385, I'm going to open up June, and I'm going to calculate, or I'm going to actually get the price of the at-the-money straddle. Okay, so I sell the put and I sell the call. At the same time, I'm getting $27.60. So if I want to quickly now calculate the value of what the 20 delta strangle would be, what I would need to do is just multiply this number by 3.3, so 30% of this number. And the idea here is to get a rough estimate. You don't need the exact price. So I'm going to do it in my head. 27.60 times 3, it's going to be 3 multiplied by 2 is going to be 6, and 7 but multiplied by 3 is going to be 21. So it's going to be the 6 plus the 2.1, so around $8.10, maybe $8.20, something like that. So the 20 delta strangle should be between 8 and 8.10, 8.20, something like that. Okay, so now let's see if I'm correct. So I'm gonna come here and I'm going to pick the closest to the 20 delta put. It's this one, and the closest to the 20 delta call is going to be this one, 415. So I'm selling the 20 delta strangle, and it's $8.02. So it's very close to the price, to the number that we calculated in our heads. Again, I didn't need to go to the platform. I just know the straddle. I know that the 20 delta strangle is going to be around 30% of the at-the-money straddle. Okay, let's do another example. Okay, I'm looking here at stock prices that are very close to a round number. So let's go with let's see, what do we have here? Let's go with Roku. Okay, Roku is trading at $109.89. So 110 is very close. Okay, so I'm gonna open up June. 109, 110. So I'm gonna get the 110 at the money. So this is the at the money straddle. So the straddle for Roku, the at the money straddle, is trading at $13.80. Okay, so 30% of that would be 13 times 30. It would be around between 420, something like that. That would be 30% of that. So I'm gonna come here and I'm going to sell the we have the delta 25 and delta 17. So I'm gonna pick delta 17. It's closer, I think, to 20. And then the call, I'm going to pick the 20 delta. So let's get a few more strikes. The 20 delta, okay, so it could be this one, 22, okay? So now we have the calculation for the 20 delta strangle for Roku is 380. We calculated it around 4, but remember that we went for 17 delta here. So this is why it's a little bit low, but it's very close to the $4 anyway. Let's take another one. Oh, I got one right here. 79.90 Qualcomm QCOM is trading at 79.91. So we're gonna go to the 80 delta, to the at the money straddle at 80. The at the money straddle for Qualcomm is going to be the 80 strike price. So we're going to sell a put, sell a call. Okay, so we have a at the money straddle for Qualcomm is $5.60. Right away, I know 30% of 560 is going to be just around 1.5, 1.7. So something like 1.7, 1.8, something in those in that vicinity. So what I'm going to do is I'm going to go and get the 73 put in this case, which has very close to 20 deltas. And the 20 delta call is going to be this one. Okay. So we said it was a little bit over 150 because The 80 straddle is the 80 straddle is 557. So 30% of that was 150 times, so 165, 170. So 170, 165, 170, something around that number. So we went from the at the money straddle at 560 times 3, which is going to be 165 or so. We went to the 73 put here. So this is the 20 delta put and the 20 delta call, which is this one. This is the closest one. And it's trading at 162. So as you can see, once you know the value of the at the money straddle, it's very easy, and you can use it as a benchmark to know the value of the 20 delta strangle. Now the 20 delta strangle is going to have, so if you don't consider the credit received, is going to have a 60% probability of profit. But once you push it further, so once you push it out by the credit that you received, you're probably going to get a good probably around 65-68% probability of profit. So you know that by having the at the money straddle, you can easily calculate the premium for the 20 delta strangle, and the probability of profit, which is pretty standard, is going to be between 65 and 68%. So I hope this information can be useful for you in your option trading, and that you can apply this information, and that it can help you make some option trading related decisions that can make you a better trader. Thank you very much for your attention, and goodbye.